Hello, welcome everyone. Myself is VL Govindarajan. After the two videos, now I am going to present about the incidence of tax under the residential status of an individual. Incidence of tax depends upon the status of a taxpayer. The incidence be higher on resident and non-resident, and the little lower to resident but not on a resident, and the lowest to non-resident. It depends the nature of income. Now, income earned and received in India, it was taxable for all three status in India. Income earned in India but received outside India, it was also taxable for all three status. Income earned in abroad but received in India. So the source of income or the receipt of income in India means that was taxable for all three status. And fourth one, income earned and received in abroad means that was taxable only for the resident and ordinary resident. Next one, income earned and received in abroad, but that business controlled from India, that was taxable only for the first two categories. Any agriculture income in India, it was fully exempted under section 10(1), it was not taxable. Past untaxed profit or income brought into India, that was also not taxable to anyone. Dividend from Indian company received in India 100% taxable from assessment year 21-22. Let we go for certain practices. Now practice 1. Mr. Vinayak submits the following incomes. Compute his total income depends upon his status. House property rent received at Delhi, it was in India, so it was fully taxable for all three status. Business income, rupees 1,45,000. Business income. The business where it was situated, nothing was given in the problem. So we have to assume that the business was established only in India. So it's Indian income, so fully taxable for all these three categories. Dividend from Chinese company but received in India, amount received in India, so it was taxable for all three categories. Fourth one is agricultural income from Sri Lanka. The land is situated only at Sri Lanka. Income earned and received at Sri Lanka. So it was taxable only for resident and non-resident. Last one, past untaxed profit brought into India, it was not taxable to anyone. So the total income may changes based on their residential status. For the resident and non-resident, the total income will be 5,89,000. The resident but not ordinary resident will be 3,49,000, and for the non-resident also 3,49,000. Let we go for the second practice. Mr. Sundar furnishes the following information: compute his taxable income for the assessment year if he is on three status. House property rent received at China. House is situated only at China, so income earned and received at China, so it was taxable only for resident. Second one, software business income from America, 8 lakh, but 60% received in India. The actual income earned in abroad was taxable for resident, but the portion 60% only received in India, that amount only was taxable for other two status category. Dividend from Italian company but received in France, it's an abroad income received in another abroad, so it was taxable only for resident and ordinary resident. For agriculture income in India, it was fully exempted under section 10 subsection 1. Agriculture income from Pakistan, 4 lakh, but 40% brought later into India. Agriculture income from Pakistan, land is situated only at Pakistan, so income earned and received only at Pakistan. So it was taxable only for resident. But later on brought to India, that will be ignored. We should not concentrate on that matter. Last one, past untaxed profit brought to India, 8 lakh, it was also fully exempted. It was not taxable to anyone. So the total income, it may changes based on the residential status of an individual. If he is a resident and not a resident, his total income was 17 lakh and 20. If he is a resident but not a resident, 4 lakh 80. He is a non-resident, 4 lakh 80. Now shall we go for practice 3. Compute total income of Mr. Ratnam for the assessment here. Profit from business in Bangalore in India, it's a Indian income, so it was taxable for all three status. Income accrued from India but received in Japan, accrued, the source of income was in India, so it was taxable for all three. Income from house property in America and deposited there. So house property situated only to America, income here received only to America. So it was taxable only for the first category. Fourth one, profit from business in Sri Lanka, 1 lakh 20, 60% received in India. So that 1 lakh 20,000 was fully taxable for resident and ordinary resident, and 60% was received in India based on the accrual basis. That 60% was taxable for other two status category. Past untaxed profit brought into India, it was totally exempted. It was not taxable to anyone. And the next is dividend paid by an Indian company but received in London. It's a dividend paid by Indian company, the source of income from India. So it was taxable for all three categories. Next one is a dividend from American company but received in India. So the receipt of income was in India. It was also taxable for all three categories. Next one is bank interest from HSBC, Hong Kong Shanghai Banking Corporation, China, rupees 1 lakh, but 40% received in India. So the total income was taxable in the hands of resident and non-resident, and 40% was taxable in the hands of resident but not ordinary and for non-residents. Last one, income from business at Italy, 2 lakh, but the business controlled from India. It was taxable for resident and ordinary resident and resident but not ordinary, because the business was controlled from India. Now in this practice we can clearly understand that the total income of the first category, resident and ordinary resident, will be 14 lakh and 30,000. You have to pay tax accordingly. And for the second, resident but not ordinary resident, his total income will be 8 lakh and 42,000. You have to pay tax in India accordingly. And for the non-resident, his income was 6 lakh and 42,000. You have to pay tax in India accordingly. In the same pattern, exercise 3, the listeners can practice it and check up the answer. Now shall we go for practice 4. Mr. Alex furnishes the following information: compute his total income based on the status. First one is dividend from Indian company. Dividend from Indian company, it was fully taxable for all three status. Second one is dividend from Kenya company, 25,000, 40% only received in India. So the full amount was taxable for resident and ordinary resident, because he is an Indian citizen, as the liability to pay tax in India. But other two residentials, the actual amount received in India only, that part only they as liable to pay tax in India. Next one, dividend from France company, 10,000, later on remitted, later on received, we should ignore that. During the current year, dividend from France company for 10,000 was taxable only in the hands of resident and ordinary resident. Fourth one, income from agriculture in Nepal, rupees 1 lakh, but received at Sri Lanka. So there is no connection in India. Agriculture income from one country received in another country. It was taxable only for resident and ordinary resident. Next one is agriculture income from Delhi. Delhi, Indian agriculture income. It was fully exempted under section 10 subsection 1. It was not taxable to any status category. Next one is agriculture income from Pakistan. 1,20,000 received in Japan. No connection in India. So it was taxable only for resident and ordinary resident, but not to others. Next one is income accrued in India but received in Dubai, 60,000. It's an Indian income. So it was taxable for all three categories. Next one is income accrued in India but received in Dubai. Income accrued in Germany, 1,50,000, but 60% received in China and the balance received in India. So 1,50,000 was taxable for resident, non-resident, and 40% received in India. That was taxable for other two status category. Last one is income from business in Iraq, but business controlled from India. That was taxable only for the first two categories. So the total income may change. For resident and ordinary resident, the total income will be 7,05,000. You have to pay the tax in India accordingly. And for the resident but not non-resident, his income will be 3,70,000. You have to pay the tax in India accordingly. And for the non-resident, you have to pay tax for his income of rupees 1,70,000. So the incidence depends upon the status of an individual. In the same pattern, the listeners can practice exercise 4. Okay, thank you. Bye.